Welcome. I'm Steve Brennan, Head of Private Wealth Solutions at Hamilton Lane. We're pleased that you can join us. Today I'm here with Brent Burnett, Global Head of Infrastructure, and our topic today is what's driving private infrastructure growth. Brent and his team are responsible for over $75 billion of assets under management and supervision. Thanks for joining me, Brent.
Absolutely, Steve. Thanks for having me.
So let's start with a question that's off the back of our recently published private wealth survey. So financial advisors have begun allocating more of their client capital to the private markets. It started in areas like private credit and private real estate. It moved on to private equity. And now we're hearing more about interest in private infrastructure. Why do you think infrastructure represents an attractive investment opportunity for advisors and their clients?
Yeah, Steve, we're definitely seeing this as well. And I think there are a couple of things. One, I would say is more macro-driven, and then two is very infrastructure asset-specific in terms of the characteristics of the asset class. And I'll start with the macro theme. So if you think about the big macro themes that are driving capital formation across private markets, I think if you ask most investors, they would probably share some of the same themes. These are themes related to AI and digitization. These are themes related to energy transition. These are themes related to supply chain optimization coming out of COVID. And lastly, these are themes related to sustainability globally. So if those are the major macro themes that investors are pursuing, we would argue that those are fundamentally infrastructure-enabled themes. And so I think there's a macro view that to participate in those major themes that are driving that global capital formation, infrastructure is a very good way to play that. And I think then at the more micro asset level, if you look at the infrastructure or the characteristics of the infrastructure asset class, it represents a really attractive place for investors to put capital. It has a very compelling risk-return profile. It has a return profile that is comprised of both capital appreciation and income. It has diversification benefits in that it has very low levels of correlation with both traditional and other alternative asset classes. And it also has positive correlation to inflation. So you have strong total returns, you have a balanced mix of income and capital appreciation, you have diversification benefits in the portfolio, and you have inflation correlation. So I think those asset level dynamics is also a big reason why we're seeing financial advisors allocate more and more to this asset class.
When most people think about infrastructure, they think about lower risk, stable, long-dated assets with contracted cash flows and target returns in the mid to high single digits. But that doesn't necessarily describe the risk-return profile of the infrastructure investments you and your team are executing. Can you talk about how you think about risk of return in the infrastructure space?
Yeah, that's an important differentiation in terms of where we target. So if you think about infrastructure, and we kind of talk about this risk return profile using some common vernacular, and that is at the very low end of the risk spectrum, you have core infrastructure. These are assets that have very long dated contractual cash flow streams, but very little growth. So investors that invest in that core area of infrastructure tend to do it primarily for the income stream. The kind of return profile for those core infrastructure assets is anywhere from 5 to 7%, but 80 to 90% of that return is coming from income distributions alone over the holding period. The issue that we've seen in some of those core assets, though, is that because they're often viewed as a fixed income alternative, they tend to have higher degrees of interest rate sensitivity, right? You can imagine these assets that have long-dated cash flows and investors are buying them primarily for the income stream tend to be more sensitive to fluctuations in interest rates. So then move one step out on the risk spectrum and you have core plus. Now, core plus assets are assets that are comprised of some balance between income and capital appreciation. You take one step further out and you're into value add. Value add may have more of that return stream that comes from capital appreciation and less from income. So where we're targeting with our return profile is that core plus and value add space within infrastructure. We like that space because we think that it's a space that if we underwrite these assets correctly, we don't have to take incremental risk, but we can achieve higher levels of return because there's some element of growth in these assets. Now, it's important to think about how we like to grow in those assets. With assets that have some element of growth to the return stream, you have to understand what risks you're willing to take in order to achieve that growth profile. The types of assets that we like to target are assets where we have very good visibility into the growth of that asset through pre-contracted construction CapEx programs. What I mean by that is we like to come into assets where there's an existing operating platform. That existing operating platform generates cash, a cash distribution yield that de-risks our position. But behind that existing operating asset, there's a pre-contracted book of business to the existing customer base that gives you very good visibility into the growth profile for that platform. This is not an exercise of, hey, let's build capacity and hope that markets absorb that capacity. This is very much an exercise for us of trying to find and underwrite assets where that growth profile is very visible through an existing customer base that's willing to pre-contract on that capacity. We don't like situations where the thesis is, hey, let's build it and hope. We like situations where the thesis is there's an existing customer base that has said, I need more capacity for this asset type, and I'm willing to contract long if you'll put the construction dollars in to build that. So we think that's the most interesting space to play in the infrastructure space because we think we can achieve incrementally better returns without taking incrementally more risk in the asset type. I think the other area where we think there's a material disconnect between risk return is in that small to mid-market space within infrastructure. When we look at our data across the infrastructure landscape, we have consistently seen large and mega cap assets trade at anywhere from 20 to 30% premiums to where we find similar assets in that small to mid cap space. And at the same time, we see much better asset level liquidity for those small to mid cap assets. So another way we try to mitigate risk in the asset class is finding assets in that small to mid cap space where we have better relative valuation entry points. There's better opportunities to add value through that pre-contracted CapEx program. And then we have better asset level liquidity when those assets are ready to sell. So if you think about that spectrum of risk return, we really play squarely in that core plus and value add, but we try to achieve that core plus value add return through good visibility to an existing customer base that's willing to pre-contract on incremental capacity.
Financial advisors and their clients are very focused on income and current return when they look for attractive investment opportunities. That would seem to play into the hands of infrastructure. Can you talk about the income benefits from infrastructure investments?
Absolutely, and that's what we think the beauty is of these core plus and value add investments as well, is that there is an income component to those returns. Now, it may not be 90 to 100% of the return. It's more of a balanced mix. Somewhere between 60 and 40% of that total return may come from the income distribution. But very similar to core infrastructure assets, these core plus and value add have an income component that can be anywhere from 3 to 5% on a distribution yield basis. They have long-term contracts with credit-rated counterparties. So the income streams are very similar to what you may see on the core side, but there's also some element of growth to these assets. I think the other component of the income that's important is that because these assets are contracted long, they typically have a inflation escalator that's built into that contract profile. So not only are you getting a predictable income stream, but because those contracts can be reset every year based on an inflation index, you're getting the secondary benefit of having those cash flow streams tied to inflation.
If we were having this conversation 5 years ago, we'd be talking about the massive gap between the capital needed to improve our global infrastructure and the amount of capital available both publicly and privately to address that need. Does that gap still exist? And what has changed over the last number of years that's fueling the demand for infrastructure investment?
Yeah, I think this is very sector specific. And we tend to think about and talk about infrastructure as though it's this sort of homogeneous asset type, right? And the reality is that it's comprised of some very distinct sectors, and that capital funding gap can be very different across those sectors. So if I were sort of looking across the major sectors of infrastructure, you'd have energy, you'd have power, you'd have transportation, you'd have data telecom. you'd have wastewater and environmental. Those are kind of the big categories for infrastructure investing today. And the sort of relative capital that's going into those sectors has changed. And I would go back 10 years, 5 years, I think there's one sector that's really come online significantly over the last 5 years, and that's been the data telecom space and the renewable power space. But if you went back 10 years, you would see a lot of capital going into that energy and power sector of infrastructure. Today, that midstream energy space does not have nearly the capital needs that it did 10 years ago. And so you've seen infrastructure investors transition more of their capital to data telecom, to renewable power, to transportation, to wastewater and environmental. Looking back at the US as an example, 10 years ago, midstream energy and traditional power accounted for somewhere between 35 and 45% of private infrastructure investment in the US. Today, that is somewhere between 15 and 25%. So what's filled that gap? It's been interest in data telecom, and it's been interest in renewable power generation over the last 5 years that's changed where that capital is going.
Gotcha. So you mentioned AI. Normally here at Hamilton Lane, when we think about AI, we're talking about the venture capital or growth equity asset classes. Can you expand on how AI has impacted the infrastructure asset class?
Absolutely. I think AI is something that infrastructure investors are especially excited about. But I think they're excited about it from the potential upside that it can drive. And here's what I mean by that. If you think about AI and what's required from an infrastructure standpoint to support that, it's largely data center capacity. A derivative of data center capacity is power. And so when infrastructure investors think about AI, they think about it from an opportunity set that involves data center capacity and power delivery to those data centers. If you look at projections for data center capacity in North America, the projections are that data center capacity is going to grow or demand for data center capacity is going to grow from anywhere between 10 and 12% without AI. Okay, so that's still very strong growth projections for data centers, even if you ignored AI. Now, if you introduce AI into that equation, you're talking about data center capacity growth expectations, demand growth expectations being somewhere between 15 and 20% for that capacity growth. So 10 to 12 is a great sector to be in when you think demand's going to grow by 10 to 12% in a sector, but you then introduce AI, and now you're talking about demand growth that's in the high teens. That's a very strong sector dynamic that will drive capital formation. I mentioned the kind of derivative of that is power. So data centers consume a lot of power. One of the biggest hurdles that they face today to their expansion capacity is access to power. And so not only has this AI interest increased the interest in data centers themselves, but it's also increased the interest in different forms of power generation that can solve the power needs for those data centers. And so infrastructure investors have shown an increased interest in all forms of power generation, traditional natural gas-fired facilities, as well as renewable generation to meet those power demands that are being driven by an AI projection.
There's been a lot of focus on the Trump administration's approach to infrastructure. How do you think the new administration will approach infrastructure spending, and how will that differ from the prior administration?
It's hard to tell. It's hard to tell at this point in the presidency. I think so far what Trump has done in his first 60 days has been pretty consistent with what he campaigned on as it relates to infrastructure. And if I back up a little bit, there was a piece of landmark infrastructure legislation that was passed under President Biden called the Inflation Reduction Act. And there were a few sectors in the Inflation Reduction Act that were touched meaningfully with that piece of legislation, and that was primarily around the renewable generation components in the IRA. And there were a few different components to that renewable policy. One of which was the extension of some tax credits for both solar and wind, but also the expansion of the types of assets that could qualify for those credits. Inclusive of the expansion of the asset types that could qualify for those credits was the expansion of who could participate in those credit markets. And so that was probably the single largest piece of that legislation that infrastructure investors have taken an interest in. Now, keep in mind, though, that these credits, the production tax credit, the investment tax credit, they have been in place since 2005. So the Inflation Reduction Act did not change those credits in terms of making them any better or worse than what they had been, but it did provide some permanency to those credits, and it increased who could participate in them. Those are the pieces that infrastructure investors are most concerned about within the IRA, because those are the pieces that they can monetize now almost immediately within those project constructs. And those are the pieces that do drive some component of the asset level underwriting. Trump has so far not indicated a willingness to make changes to those underlying credits. And the expectation is that he likely will not make changes to those credits. So I think the risk of wholesale changes to the credit markets is pretty low. If you look at where he has made changes, these are things that he telegraphed during his campaign. He's put a moratorium on federal leasing for offshore wind. In the U.S., that was a very small subset of the private infrastructure market, so I would say not a large impact to the infrastructure opportunity set. He's also changed some of the direct subsidies around electric vehicles to consumers. Again, that was a place that infrastructure investors were not really deploying a lot of dollars. Those EV charging models were still very early stage, so not really a target for infrastructure investors. So with that change in the policy, I would expect little change to the opportunity set for infrastructure. There are a couple of things that he did that I think or is likely to do that I think will be net positives to infrastructure investors, and that is he's indicated a willingness to improve the environmental review process, lower some of the barriers to permitting for all types of assets. He's likely to remove the ban on LNG export capacity. So LNG export capacity was a big target for infrastructure investors. Some of those capacity expansions were put on hold during the Biden administration, so that is likely to come back as an opportunity set. So I think the major kind of infrastructure incentivizing pieces of the IRA as it relates to credits are probably going to be okay. There are some sectors on the margin that were not big targets for infrastructure investors that are likely to be impacted. And then there are some sectors, both renewable generation, but also some forms of traditional power and traditional midstream energy that are likely to see positive benefits as a result of some of the policy changes from the Trump administration.
And so last question, if we think outside of the U.S., what would be the global impact of a change to the U.S. infrastructure spending policy?
Yeah, infrastructure is still, for the most part, local. It's a local business, right? These are assets that move people, data, electrons, goods over local market networks. And so when I think about infrastructure policy, whether it's in the U.S. or whether it's in Europe, those policy overlays tend to have a greater impact on those local market assets than they do globally. But there are a couple of things to keep in mind on that. One, I mentioned the LNG export ban. So LNG is a global commodity. There have been LNG import facilities being built in markets around the world. Those import facilities need export facilities to provide that commodity to those import facilities. So I think to the extent that there's a change in policy towards the LNG export facilities, that's going to open up markets for import and change that global pricing dynamic. I think the other thing that we've seen with the federal government in the U.S. is the federal government has a fairly weak policy impact on power markets in the U.S., which is interesting because internationally those power markets tend to be much more coordinated from some kind of federal regulator. In the U.S., the federal overlay is quite weak. Most of the power market policy is determined by the independent system operators, which are unique to the regions where they operate. And then there's state policies that continue to drive renewable energy standards in the U.S. And so I think the likelihood of a federal policy change materially impacting global infrastructure assets is pretty low. Even at the state level, between the ISO policy and the state policy on power generation, there are certain types of power generation assets that will continue to be very attractive, independent of what that federal policy does. We couldn't be more excited about the opportunity set for infrastructure right now. We think this is an asset class that prospectively can continue to generate very compelling returns with strong downside protection. And we're excited to be able to offer exposure to this asset class through multiple vehicles to our investors.
Thank you for joining us. If you have any questions on what we've discussed today, please reach out to any of us here at Hamilton Lane.